Good morning or afternoon, everyone, and welcome to the Lease Accounting Rules and Overview with Examples webinar presented by Hein Associates. I'm Shannon Reddy, your moderator and webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted. Please use our chat feature to ask questions. We will save time at the end for Q&A. This webinar is being recorded. A copy of the webinar presentation and its recording will be sent out to all registrants later today. Your active participation is important throughout this session. In order to receive CPE credit for this, you will need to be connected for a minimum of 50 minutes and must answer 75% of the polling questions included throughout the presentation. Immediately following this webinar, you will be directed to a survey page where you can leave comments. Please check your inbox later today for a follow-up email that contains an evaluation form that must be submitted in order to receive your CPE certificate for the course. Our presenter today is Billy Tallada, an audit partner in our Houston office. Billy has over 20 years of public accounting experience. He has provided audit and consulting services to private companies in energy, real estate, technology, and manufacturing/distribution industries, assisting them with due diligence services and private offerings, as well as mergers and acquisitions. He is also a faculty instructor for the AICPA, teaching CPE courses on a wide range of accounting topics to CPAs throughout the United States. In addition, he is a frequent guest lecturer at the Bauer College of Business at the University of Houston. Thank you for attending today, and I would now like to introduce Billy Tallada.
Thank you, Shannon. I want to welcome everyone. This is my first time doing a webinar. I've done a lot of live presentations of this presentation, so I hope it's as interesting here in the webinar as it is in person. This presentation is probably a little bit different. I've gone to some lease CPE, and one of the things that I always felt like they were lacking is they were lacking examples. You know, I mean, they talk a lot about the theory and what's going to happen. And so what I tried to do with this presentation is actually give you some real examples that you can take with you with real numbers and real journal entries that hopefully will help you out. Okay, so let's get started. Real quick though, there has been 3 major projects by the FASB the last several years that's taken up most of their time. Surely you've heard about revenue recognition, which is one, financial instruments, and leases. Okay, and you think about who's going to be impacted by these 3 standards. Certainly all of us, most of us have revenues, right? So revenue is going to be a very impactful standard, but I would say it's probably going to impact certain industries more so than others. You think about technology, software, multiple deliverable elements. They're going to have significant changes to how they record revenues today versus under the new standard. You think about financial instruments. Financial instruments really applies to certain companies with financial liabilities, financial assets, investments, probably not most of your mainstream companies. And then you have leases. And I would argue of those 3, at least for my client base, a lot of mid-market type companies, leases is going to have a very big impact because, you know, my 20 some odd years of auditing, all my clients, someone had at least one operating lease that they're going to have to change the way that they're accounting for it today. So anyways, with that, let's start on the first slide. You know, first question you ask is, hey, why are they issuing this standard? I mean, I like our current rules. I don't think they're all that bad. And to give you a little history of it, the battle for this started a long time ago, okay, before the original lease standard came out, which is FAS 13, if some of you can remember way back then. The battle was between academics and practitioners, okay? So the practitioners are you guys on this call, most of you. And with the academics, their point was, look, if you sign a piece of paper, you sign a contract that says you're going to pay somebody some amount of money into the future, then to us that seems like a debt or an obligation that needs to be a liability on your balance sheet and reflected. And I got to be honest with you, it's really difficult to argue with that. From a theory perspective, that is correct. But the practitioner's counter argument was, look, for us to implement this, it's going to take a lot of time, a lot of effort, and it would be very difficult on the practitioner. So they came up with a compromise, which is in FAS 13, which all of you that have operating leases deal with this, is to put a disclosure in the footnotes of all of our operating lease commitments. So the practitioner would say, look, the users of these financial statements, they know all of my lease obligations because I've disclosed all my operating leases in a footnote, and of course our capital leases are already on our balance sheet. Okay, so that was the other side of the argument. Now, fast forward many years, you know, we hear about Enron, and we learned some acronyms we never knew before, VIEs, SPEs, and the focus became on getting all of our off-balance sheet items onto the balance sheet. Okay, so here we are today in a webinar after all these years of the battles. So, and also, going back to the slide, the accounting depends on the classification. You could have two similar equipment leases with very similar terms, but based upon criteria, one could be an operating lease and one could be a capital lease. And as you guys know, you get very different accounting treatment. As I mentioned, contractual rights and obligations are off the balance sheet, so we'll be getting them on with this new standard. And also, a lot of users already adjust the financial statements. You know, your bankers, I know in our firm, we have some deal people do transactions. Many of them are already making adjustments for leases, or at least considering them in their future commitments. Okay? And then also, you know, the rules that we're currently under provide a lot of structuring opportunities. You know, I had, and I think there may be some people on this call that have been clients that have called me over the years and said, hey, look, I just stepped out of a meeting. I'm trying to negotiate this lease. Can you help me figure out the criteria, because I don't want this to be a capital lease. So the rule makers didn't really like that you could structure a lease, structure a contract to get the accounting treatment that you want. All right? So that's some of the background of the why we're doing all this. And what's the impact, okay? So, you know, a lot of companies are going to be impacted more so than others. I think it's estimated $2 trillion in leases will go from off-balance sheet to on-balance sheet. Some of the companies are going to have a bigger impact. Well, obviously retail. I mean, you think about retail. If you have retail locations all over the place, those are going to need to make their way to the balance sheet. Think about a company like Starbucks. You know, Starbucks doesn't own all these facilities that they have stores in. You know, they're typically leasing those from people. So all those operating leases will need to make their way to the balance sheet. Okay, I think they've estimated almost $6 billion will be coming on their balance sheet. Another one's telecom. You know, when I first heard this, I thought, why would telecom, well, you know, why would that be impacted? But think about what telecom lease a lot of, and think about cell phone towers. You know, I have an aunt that used to farm. Great aunt, used to do a bunch of agricultural type stuff. Verizon approached her to put this huge cell phone tower on her land, and she got out of farming and all that business, and now just collects checks. So telecom has lots of cell phone towers all over the place that they're going to need to also bring onto their balance sheet. Another thing that's kind of interesting is banks. Another one that I didn't really think about all that much, but I guess think about, what do banks, you know, what would they have a lot of leases of? And think about where you get your money from. We get our money from ATMs, right? ATMs are all over the place. Banks have to lease that space that they use in a facility for a particular ATM. So they will feel the impact of that as well. So anyway, there's more. You could have restaurants. I don't deal with airlines, but airlines, you know, lease planes. So again, some more so than others, but I'm sure all of you have some sort of operating leases that will be impacted. All right. All right, pros and cons. Well, obviously, I told you about the pros. the goal of this is to get all of your off-balance sheet items, things that are financing leases, get them all reflected on your balance sheet. Okay, so that's the goal of this. The cons to it is it's costly to track and calculate, as I mentioned. And, you know, a lot of people ask me, usually at the end of this, they say, hey, is there some sort of software that I can use to help me calculate all this? And I'm hopeful by the end of the presentation, you'll see that this is fairly easy. It's time value of money calculations. I mean, it's not rocket science. However, the costly, difficult part is you guys have a lot of leases that are in PDF form, paper form. How do you get the information out of these documents into some manageable format that you can use, manipulate, and comply with these rules? That's the challenge, okay? Secondly, users are going to need to adapt. I mean, I think if something for a lot of you, especially if you have a financial covenant that has some sort of leverage ratio, it'll be interesting, and I've talked to some bankers, and they will specifically exclude some of this stuff, but you need to make sure they understand how they're going to treat it in your loan document, okay? Because this is going to add debt and an asset to your balance sheet. It's not going to impact your income statement, but it's going to add debt to your balance sheet. How's it going to impact your leverage ratio and some of your financial covenants? So that's something else that if you have a debt agreement that's going out several years, maybe something that you want to talk to your banker about. All right? So who does this apply to? Pretty much all leases, okay? Excludes leases of intangibles, software, internal use software licenses, explore for natural resources, biological assets. It's going to include all your capital and operating leases. One thing I don't have on the slide, it's going to exclude short-term leases, leases that have a maximum lease term of 12 months or less, or less than 12 months, sorry. So we'll talk about that here in a few slides. Okay, so what are the effective dates? For public companies, if your calendar year in, it will be 2019. Private companies, 2020. Okay, some people have asked, hey, aren't they going to delay this or do away with it? I don't think that's going to happen at this point. I think the horse is definitely out of the barn, and he's not coming back. So this is definitely here to stay. I have not heard anything about delays or pushing this out any. All right. Okay, we'll to our first polling question. Yeah.
Yes, thank you, Billy. We have our first polling question here. Which lease does not fall under the new lease accounting rules? Please select from the below. Lease of an office building, lease of a new airplane, lease of a used forklift, lease to explore for or use natural resources. We'll give you guys a few more seconds, and then we'll close the poll to see the results. All right, and here are the results.
Okay, moving on to what? So real quick, let's just have a real quick refresher on our current rules, so everybody knows what we're dealing with here, what we're doing under the current rules. Obviously, operating leases are not on the balance sheet. We have to disclose those in an operating lease commitment schedule footnote. They're off balance sheet. Your capital leases are currently on the balance sheet. Okay, so we're recognizing them on the balance sheet. We're imputing interest, calculating present value. And to be honest with you, you're not going to have a ton of changes. You're going to have some changes to capital leases, but for the most part, it's going to be the same. All right, and I'll show you what some of those differences are. But mainly, it's going to be around certainly around operating leases. Okay. So let's look at our current rule criteria, and this is going to change somewhat. We're going to add some, it's going to change a little bit. For the most part, it's going to be the same. So under our current rules, if you meet any one of the following 4 criteria, then it would be a capital lease. Okay, if you don't meet any of the criteria, then you're an operating lease. So real quick, if you own the asset at the end of the lease term, well, that's pretty obvious, right? You're just financing the purchase of equipment or something like that through the lease. All right. If you have a bargain purchase option, something below market value or below market price, then that would be a capital lease. If your lease term is 75% or more of the useful life, then they're saying that you've used up most of the useful life of a particular equipment capital item. And then lastly, the present value of the minimum lease payments required is at least 90% of the fair value. And I'll tell you, man, over the years, I've had clients literally come to me and it could say 89 point, and this is a real example, it said 89.98% was the present value of those minimum lease payments. And they were arguing that, hey, the standards say 90%, and 89.98 is not 90%. So if you've ever gone through this calculation, you can change discount rates, you can change fair values, you can really, you can play around with the numbers to get some of the present value figures to get what you want. Okay, so we're going to, under the new rules, they're going to do away with some of that bright line criteria. All right. So under the new rules, big picture, lessees, we're going to have a right of use model. Okay, so you're going to call these assets right of use assets, because if you think about it, you don't necessarily own these leases, like operating lease, you don't own that space. For a lot of your capital leases, you just have a right to use. Okay, so that's what they're going to be calling those assets. All right. Now your exemption is short-term leases, something that is less than 12 months. Okay, we'll talk about that a little bit later, but if you're less than 12 months, so you have a copier or something short-term, that would not apply to these rules. Okay, today, for time purposes, we're not going to go through much for lessors, but I'll be honest with you, lessors have not changed significantly from our current rules. Reason being, if you think about lessors, a lot of the rules are going to fall under revenue recognition. So if you're a lessor, you want to look at some of the Rev Rec rules to see what's changed for you, but there's not a ton of stuff. So that stuff is still the same. All right, so first question you need to ask under these new lease rules, because they make a couple changes, is what is a lease? So the first time I read this, I thought, well, this is pretty straightforward, right? I mean, you have a contract between two people, or between two parties, and they're going to fulfill that contract. You're going to use some asset, some space. But what they've done is they've defined it a little further. Is you have to have the right to control the use of that asset, and you have to meet two criteria for it to be a lease. Okay? One is you need to have the right to obtain the economic benefits from the use of that asset. And secondly, you have to have the right to direct the use of that asset. Okay? So you need to have both for it to be considered a control and be considered a lease. So a real easy example is, my firm leases space in downtown Houston. So we've got a floor in Allen Center. Well, we have the right to direct the use of this space. We can put whatever artwork we want on the walls, tear down all the cubes, do whatever we want. We control the use of this space within reason, obviously. And then our employees are all out, working on their computers, doing whatever they do, and we get the economic benefits from that. So that's a pretty easy example. Where I would say you'd find difficulties is if you're leasing stuff related to cloud computing, network services, something that's IT related, you get questions of, do you control that asset or not? Okay, so let's look at a real quick example. I've got some examples. I'm going to go through these kind of quick so we have plenty of time. But Watt Company needs an upgrade of its network. So they get into a contract with Altuve. They get network services. Altuve installs, configures all of this stuff for Watt. Altuve is going to operate, reconfigure, replace, do everything as necessary. And if you read the last sentence, that's the most important one. Watt is unable to make any significant decisions about the server's use. So the way I would look at this, simple example is that Watt has pretty much outsourced, all of his network function to Altuve. Okay, so Altuve does all that. Watt's not making any decisions about the servers, and he enters into a contract because if we go back to our definition of a lease, because Watt does not have the right to direct, even though he gets the economic benefits, Watt doesn't have the right to direct the use of an asset, this would not be considered a lease. Okay, so this would be considered a service contract. All right, now this is important because if it's not a lease, you don't need to go down this path and deal with all this accounting. All right, so that makes it a lot easier on you. So, you want to make sure that you meet a lease. All right, there's another example, but I think it's pretty straightforward. Okay, let's look at the lease term. Okay, so we've determined, is it a lease or not? Okay, and now we're looking at it, what is the lease term? So the lease term is, it used to be, and for me, I'm thinking about the lease term, it's just whatever the lease says it is, right? Whatever the non-cancelable term is. Well, at the commencement date, we got to also still determine what the non-cancelable lease term is, but there's 3 other things that we need to consider. All right, and this is where it gets a little bit tricky, and I know accountants, we don't like judgment, but we're going to have to use some judgment in this area. All right, so if I have a non-cancelable lease term, I've also got to consider in point number 2, any periods covered by an option to extend the lease, and if it's reasonably certain that I'm going to exercise that option. Okay, so example, I've got a 5-year non-cancelable lease term that I signed, and I've got an option to extend it for 3 more years. All right, I have to assess at the commencement date, am I reasonably certain that I'm going to exercise that option? If I am, then now I've got an 8-year term. All right, and I'm going to tell you in the next slide how the standard wants you to determine what reasonably certain is. Okay, conversely, in point number 3, if I have any periods covered by an option to terminate the lease, okay, and it's reasonably certain that I'm going to terminate the lease, then I need to take that into consideration. So let's just say I sign a lease that has an option to terminate after year 3. If I know that I'm going to terminate that, and I'm reasonably certain that I'm going to terminate at the end of year 3, then I have a 3-year lease term. All right. And then lastly, on point 4, if there's any periods to extend or not extend in which the option is controlled by the lessor, then you would have to include that as well. All right, so the thought is by the rule makers is if it's controlled by the lessor, they're probably going to invoke that option to extend or not extend. All right, so this is important. Your lease term is important because if we're doing time value of money, think about the inputs to get your time value of money. I mean, lease term is the longer the lease term, the more valuable the asset, the larger the liability. Okay, and we talked about short-term leases, so something with less than 12 months, all right, 12 months or less. Okay, so what determines reasonably certain in assessing the lease term? And really there's not one factor. This is straight out of, just kind of summarized out of the guidance. They want you to use a combination of factors, all right? So contractually, are the lease payments, in the extension period, that option period, are they favorable? So do you have an economic incentive to actually extend that lease term? What are the terms of the renewal options and costs? Another thing would be your location of the asset. If you've been located in downtown Dallas for 30 years, chances are you probably will extend. Reasonably certain to extend. Conversely, let's say you had a firm, and I'm just going by this, we had an audit firm that the managing partner has had this office here in downtown Houston for 30 years, but maybe the new managing partner lives in Sugar Land, Texas, and he or she wants to move the office out to Sugar Land. So maybe now I'm reasonably certain I'm going to terminate the lease early. So you could have significant leasehold improvements. There's a lot of different things, and I think if you look at the implementation guidance, they want you to be 70 to 80% sure. Use that as a guide for being reasonably certain. Okay, so there's a lot of different factors that you would have to consider in determining the lease term. All right. Now, there is times when you're going to reassess the lease term. So if there's a significant event or change in circumstances that occurs, then that changes our determination of reasonably certain, we would adjust our lease at that particular point. So you could modify a lease. Again, something could happen to where now I'm reasonably certain I'm going to exercise an option, or now I'm reasonably certain that I'm going to terminate. Okay, so this gets reassessed as time passes on and as events occur. All right, I think we're up to another polling question.
We are. Thank you, Billy. Question number 2. What must be considered in determining the lease term? Please choose from the below. Non-cancelable term, periods covered by an option to extend the lease, periods covered by an option to terminate the lease, or all of the above. Please make your selection now. And everyone selected all the above.
Shannon, I think our polling questions are too easy. So
yeah. We'll work on that for next time.
Okay. All right, so moving on. So we've talked about, is it a lease? We've talked about what is the lease term. Okay, now we need to determine out what's included in our lease payments. Okay, because think about, again, going back to time value of money, calculating present value, minimum lease payments and stuff like that. You know, you need to have a time period, but you also have to have some sort of fixed payment to calculate, to go out in present value. So first off is our fixed lease payments. Okay, that's pretty straightforward. So if you lease a piece of equipment, you lease a building, you lease something, whatever our fixed lease payments are, minus any types of incentives, that's obviously going to go into our lease payments. Okay, second is if you have some sort of variable lease payment, and this is important, if it's tied to an index or some sort of market rate, like consumer price index, maybe some sort of rate, that would be the only other thing that you would include that's variable. I'm going to get to some other variable items. Third is a purchase option. Okay, think about it, and this probably would apply more to equipment type items, but if you have a purchase option to purchase equipment, and you're reasonably certain, there again, we got that term again, reasonably certain to exercise that option, then that would be included as well. I'm going to show you an example of that. Fourth, if there's termination penalties, let's say that we know that we're reasonably certain that we're going to terminate a particular lease at a point in time, and we have to make some sort of payments, we would need to include that in our lease payments as well. All right? And then last, if there's a residual value guarantee, and this would be a situation where maybe you guarantee the value of a piece of equipment at the end of a lease is going to be $10,000. You know, the lessor can only sell it for $3,000, so you have to make up the difference. You know, when you know that amount, that's another amount that needs to be included. So these are all your payments under the new rules are going to be included in our lease payments. Again, this is important because the more stuff that gets included in our lease payments, the bigger the liability and the bigger the asset that you're going to have to put on your books. Now, notice I don't have any non-lease components on here. Okay, people always ask me, I'm going to get this in a couple slides, people always ask me, you know, what about my common area maintenance? What about taxes? What about insurance? That's not something that you include in your lease payments. However, they have a practical expedient to help you with that, which I will walk you through. All right. So just reiterating some of the stuff I just said. So if you have variable lease and payments that were not included in what we just discussed, now think about restaurants. Restaurants have some of their leases are written a percentage of revenues they have to pay to their landlord, or other variable type items that would not be included in your lease payments. And frankly, if you think about it, it's hard to do some sort of present value calculation or of annuity payments if you have a bunch of variable items. You really need some sort of fixed payment. So variable lease payments would not be included. Guarantees would not, and also amounts allocated to non-lease components, which we'll get to, but that would be items like common area maintenance, insurance, taxes, that type of stuff. All right, but again, we got a practical expedient to help us out with that. Okay, another thing that's a little bit different than what we've been doing is initial direct costs. All right, so they've sort of narrowed the scope of what can be capitalized as part of a lease, some of our direct costs to getting the lease, and they really narrowed it to any costs that have been incurred that result in a successful lease. Okay, so that second bullet point is important because a lot of people get this wrong, is that if you have things that you would have incurred regardless if it was a successful lease or not, those would not be capitalizable. All right, so let me walk you through an example on that to kind of hammer that point home. So we got an example here. So we got Keenum Industries. Keenum needs office space, okay? So he goes out and gets some office space from Ward Realty, and he incurs some costs to acquire this lease. All right, so probably under our current rules, it would be sort of our normal operating lease that we have, all right? So Keenum pays a real estate agent $12,000 commission, okay? Typically, you only pay commissions to real estate agents whenever it's a successful lease. And we know from our previous slide that that would be capitalizable, okay? So that would be capital as part of the right of use asset. And I'll show you how that gets done here in a few slides. The next is legal fees, okay? So Keenum incurs some legal fees for negotiating the lease and reviewing lease documents, okay? And that ends up being $10,000. Okay, so what Keenum needs to ask himself, am I only going to pay this if I get the lease from Ward? And chances are is if he gets the lease or he doesn't get the lease, he's still going to have to pay this $10,000. So this would not be capitalizable as part of the lease. All right? Third, time spent by management, lease negotiations, meeting with advisors. Again, you're going to pay that either way, whether it's successful or not successful lease. Fees for credit analysis, you pay $1,000. And so Keenum, he incurred that $1,000. He still has to pay that regardless if it's a successful lease or not. And then lastly, accounting for staff time. Unfortunately, the accountants can't capitalize all their time for learning all this accounting. So anyway, it's kind of narrowed it to again, things that are just allow you to get successful leases, and that would be commission. All right. Okay, so let's look at non-lease components. This is an important slide, all right? I'll kind of highlight. This is something that you want to make sure you understand because a lot of people get tripped up on this. And I think it's helpful to walk you through an example. But Keenum signs a 5-year lease with Ward for $15,000 a year, okay? This is an office lease, so this space is in a mixed-use facility, and that annual payment covers Ward's performance, the common area maintenance, which you think about it. If you get a building, built into that $15,000 is cleaning the common area. Somebody's got to do the parking lot maintenance, landscaping, utilities, all that stuff. So Keenum just has to pay $15,000. Doesn't have to worry about all these other costs. Ward also bills Keenum $500 fixed every month for real estate and insurance. Okay, so under the rules, you're required to separate the lease and non-lease components, okay? So we got to think about it. What are the non-lease components? So in this simple example, we're paying $15,000 a year, but buried in that $15,000 is there is some portion of that goes to cleaning. Somebody's got to pay the cleaning people, the person that does the maintenance, landscaping, all that stuff. So if we determine the fair value of all of those services is really $2,000 a year, we would exclude that from the lease, okay? And we would say that the lease is really the cost to really the right to use this facility my lease payment's really $13,000, okay? And the taxes and insurance are kind of non-lease components too. Now, thankfully, the rule makers said, you know what, that's going to be kind of cumbersome for people to do. So they've given us a practical expedient that allows you to make an accounting election to combine all this into one lease component. Okay, so if you were to elect the practical expedient in this example, you could take the $15,000 and include the $500 because it's a fixed cost as part of your lease payment. Okay, so electing the practical expedient will save you a lot of time. Now, I want to tell you this though, the flip side of it is the bigger your payment, the bigger the liability you're going to hang on your books. Okay, so if you're concerned with getting a large liability, if you were to carve out the non-lease components and follow the more onerous part of this lease standard, you could potentially have less of a liability and less of a right to use asset if that matters to you. So something to consider, all right? So, all right, so we also, under these new rules, we still have to go through the classification because we've got to put it into two buckets, okay? So we've got to put it into capital, or sorry, we're going to change from capital lease. They're going to start calling these finance type leases, all right? So the term capital lease goes away. We're going to now have a finance type lease. And we're still going to have the operating lease designation, all right? We're going to go through very similar criteria. So I'll walk you through that. And, you know, obviously, just from a theory standpoint, a finance type lease, you consume a significant portion of the underlying asset. So think about, you know, equipment, cars, if you have forklift, if you had an airplane, you know, typically those leases, if you consume most of its useful life, then chances are it's going to be a finance type lease, okay? Your operating leases are usually, you know, I think about renting space somewhere, an office building. You know, again, back to my example, we're in Allen Center in downtown. We do not consume a significant portion of that asset, and this building will be around for a long time, even if we're gone. So, anyway, that's some of the theory. Let's look at the new criteria for a finance lease, okay? And as you can see, this is very more principle-based as opposed to rule-based. Okay, but you see very similar criteria that we have in our current rules. So let's go through it real quick. So we have the ownership. You know, we still own, you own the asset at the end of the lease term, then that is a finance lease. If you have a purchase option, now again, they don't say bargain purchase option, so that's a change. And again, if you're reasonably certain that you're going to exercise that option, then that would be a finance lease. So again, we've got some more judgment involved that we maybe didn't have so much in the past. So if you know that you're going to exercise and buy it, it becomes a finance lease, okay? Lease term, all right? Notice here, this is very important, we don't have that bright line test where lease term is for a major part of the remaining economic life, okay? Under the slide I showed you earlier, it said 75%, all right? If you do go to some of the implementation guidance that is in the standard, they do have a number that you can use, and guess what? It's 75%. So the implementation guidance surely suggests that you can use 75% as a guide, although it's not explicit in the rules. Present value minimum lease payments, very similar. You know, it's used to say 90%, now it says substantially all of the fair value. But guess what? The implementation guidance has a number you can use, and the number that they use is 90%. So again, not explicit, but you can kind of fall back on that number again. And the last point is something that's new. We didn't have this before, but if you have a specialized asset, so if you're leasing something that is such a specialized nature that it's not going to have an alternative use at the end of the lease term to the lessor, then that would be considered criteria to meet for a finance lease. Okay, remember, you just have to meet one of these. And the change here is going to be, it's going to change your income statement. So if you're a finance versus operating, finance has very different income statement treatment. It's basically the same that we have now versus an operating lease. Okay, so it's important to get this right. Okay, the other thing too, we got to look at what, we talked about we got to get a fixed payment, we got to get a lease term. We also got to figure out what is the rate we use, okay? And so if you pull this right out of the standard, it's just what would you have incurred to borrow funds to buy that leased asset or, rent space, whatever you're doing, okay? And I think there is practical expedient for non-public companies to use a risk-free interest rate, so to help you out, but that's pretty straightforward. Not a lot of changes in what we've been doing in the past. All right.
Next polling question. Okay. Which one of these is not part of the criteria to be a finance lease? Please choose from the below. Ownership, purchase option, undisclosed cash flow payments, specialized assets. Please make your selection now. Perfect. And here are the answers.
Okay, yeah, back on that one. Undiscounted, let me just slide back. Yeah, it should be discounted cash flows of payments. So 65% of you are right. Good job, guys. All right, so let's look at the journal entries. Accountants, we all love journal entries, but your finance type lease, again, that used to be called a capital lease, really not a lot of changes from what you're doing right now, okay? You're going to call it a right-of-use asset. It's kind of weird, but again, your present value of your lease payments, it's your liability, there's your asset. We've got some different factors and reasonably certain to consider. Your subsequent recognition is essentially the same that you've been doing. We're going to amortize, depreciate it over its useful life, and then we're going to measure the lease liability just like you would any other amortization type schedule, okay? So not a lot of changes there, pretty straightforward. Operating lease, this is where things are going to change. I'm going to walk you through an example, all right? And you're going to have that right of use asset on your books, the present value of the lease payments made over the lease term, and you're going to have a liability, okay? Now, I told you at the beginning your income statement's not going to change, okay? When you recognize your right of use asset for an operating lease, the expense is still going to go to rent expense, all right? You're going to have a liability when you pay it off. You got to reduce your liability. You're going to have accumulated amortization in cash. So let me walk you through some examples while we have time to go through these. All right, so I've got an example here. So we've got Hardin Industries, okay? Hardin gives in a 5-year lease with Capella, all right, for a specialized piece of equipment. All right, specialized is a key word. That's a hint. That's used to produce a steel lithium beard trimmer, which is the only profitable product offered by Hardin, as Hardin and his group tries to grow their market share of her products. All right, so we got a couple questions at the bottom. Is this a finance lease or an operating lease? And what's included in my lease payments? Okay, so remember, I've got this criteria I've got to kind of measure up. Is this a capital lease or an operating lease? So just real world. For me, I think about, well, if you're leasing equipment, it's probably a finance or capital type lease. Well, let's go through the criteria. So my first criteria is, do I own this at the end of the lease? Well, none of the facts here tells me I'm going to own this at the end of the lease. So that's no. Okay, my second one is, do I have a purchase option? All right, well, I do have a purchase option, but the rules tell me I have to be reasonably certain to exercise that option. So the question is, am I reasonably certain to exercise that option? Well, I'm not really sure. Okay, so let's come back to that one. My lease term has to be, remember the implementation guide tells me 75%. Well, I've got a lease term of 5 years. It looks like my economic life, and the example says 10 years, so that's 50%. So that's definitely a no. And then the last one is the product so specialized that there's not going to be an alternative use to the lessor at the end of the lease? Well, they tell us in there that it's specialized. So I would probably say yes under specialized. Now let's go back to the purchase option. am I reasonably certain to exercise this option? Well, they give us in this little limited fact example, this example here is that it's the only profitable product offered by Hardin. So the thought is Hardin has an economic incentive to buy this equipment when he starts the lease because that's the only way he's making money. All right, so that would be another factor to say yes. So you only need to meet one. So my guess is this is a finance type lease. Okay. So next is what do we need to include in our lease payments? Well, obviously the $65,000. Right. That's my fixed annual lease payment. All right. I have to also include that option to purchase the equipment for $90,000. All right, because at the end of 5 years, I'm planning on buying that. So I have to present value that $90,000 back to the present. Okay, so let's look and see how all this works with journal entries. So as we mentioned, there's an economic incentive for Hardin to exercise the purchase option. Got a lease term of 5 years. So that lease payment, we got to take our present value of those 5 payments of $65,000. And we present value the $90,000 at the end of 5 years, all at 6.5%. That's Hardin's incremental borrowing rate. Amortize it over 10 years. We accrete the interest, and then in theory, on our amortization schedule, at the end of the 5 years, we should have a liability of $90,000. Okay, so let's look and see. We all love journal entries, so let's see how this is going to look. So at inception, I've got my right of use asset, $335,000, and that was my present value. So get your calculators out if you want to, but there's a present value of $65,000 for 5 years, and taking that 90 and bringing it back to the present at the end of 5 years. And this is very similar to what if you have capital leases now. I'm going to amortize it over 10 years. That's its useful life. And then I have my lease. Every time I make a payment, I've got to reduce my lease liability, and I've got a portion going to interest. Okay, so like I said, this should not be as difficult for you because if you have capital leases, you're probably doing it, but it's more difficult, a little bit more on the front end in assessing some reasonably certain items. Okay, so let's look at an operating lease because this is where I think you're going to have a lot of changes. All right, we have Shasta. Okay, so Shasta, she's entered into a lease for some office space in a building with the following conditions. Okay, and we need to figure out, what's the lease term and what's our journal entries. So we've got a 10-year non-cancelable lease with an option for 5 additional years. So I read that and say, okay, do I have a 10-year lease term or do I have a 15-year lease term? Okay, I need to say, am I reasonably certain to exercise those additional 5 years? I've got fixed lease payments and I've got some, option years in there with $55,000. I've got commission costs, I've got an incremental borrowing rate, and they make it easy on us because Shasta says that she is reasonably certain not to exercise that option. So we know it's definitely 10 years. We don't have to mess with 15 years. Okay? So that's easy. So let's look and see what our journal entries are. So as we said, lease term's 10 years. So I've got to take my present value of all my lease payments. Okay? Now, this example is kind of throwing you because we make upfront payments. We obviously don't need to discount the first upfront payment. So I've got 9 payments that I need to make at the fixed rate, which is $50,000. We take 5.87% over 9 periods, and that equals $342,000. Okay, so that's just time value of money, present value in those payments. So really no magic there. Remember also we have to add in our initial direct costs. So I paid someone a commission to get this space, so I get to include that as part of the capitalization of this. I made an initial upfront payment, so we don't need to discount that, so that's just $50,000. So I have a right-of-use asset of $407,000. Okay, so let's kind of look and see how this works. So I want you to look at the screen, because this is where people usually, if I'm doing it live, people kind of shake their heads and go, man, I can't believe I got to do this kind of stuff. But so at inception, you take this 407 that we calculated, and you're going to debit an asset for an office building. Okay, this is office space for this example. So Shasta would make this entry. Okay, we made an upfront payment of $50,000 because that's what the landlord required. So we paid $50,000 up front. We also paid a commission to somebody. That's how we get to the $65,000. All right. I also have my lease liability of $342,000. I showed you how I calculated that. I present valued all my payments, so there really wasn't any magic to that. And the entry balances. Okay, so that is something you have not been doing in the past. Okay, that entry is going to make your balance sheet, going to make Shasta balance, going to make all these companies' balance sheets just get grossed up. All right. So after year one, the income statement doesn't change all that much. All right. My rent expense in this example is still straight line over the term of the lease. Okay, so we paid $50,000 a month, so I've got $50,000 in expense. I've also got a straight line that commission, which would we say was $15,000, so that goes over 10 years. So my rent expense is going to be $51,500. All right, so that's what I have as my debit. I pay cash, and I mean don't get caught up on all these entries, but I've got cash. I have to reduce my lease liability, you know, certainly as I make payments. That $342 has to go down, and the offset's going to be here is going to be to accumulated amortization. All right, and that essentially becomes a plug because I have to get that right of use asset has to go down. That $407,000 will be reduced every time you make payments. So that gets reduced, and I'll show you a little bit here at the bottom how it's calculated. All right, but the main thing here is your balance sheet gets a lot bigger. All right. So some of the stuff I think we've already talked about, but you know, old rules versus new rules. We talked about some of this, you know, balance sheet. One thing I want to mention too is that you also are going to have to subject your right of use asset to impairment testing. Okay, so you could have entered into a lease, and that corresponding asset, if we go back to this right of use asset, that potentially could be impaired. All right, and in one situation that could be the case is if you have to lease a particular facility. I've got some clients that've got big warehouses up in North Dakota, and they're not using those, so they're subleasing them, but they're subleasing them at a fraction of the dollars of the main lease. Okay, that'd be a situation where you get with your auditors, you may say, hey, we may have some sort of impairment. So that'll be something that you'll have to also look at. Okay, so remember, we used to call this a capital lease. Now we're calling it a right of use asset, so that's a little bit different. Income statement, I don't know that you have a lot of changes. Cash flow is essentially the same. We don't have any changes there. I think we have one more polling question, so let's get to that because I got a couple more slides I want to get to before we run out of time.
We do. Question 4. Which statement is impacted by the lease standards? Income statement, cash flow statement, balance sheet, or equity statement? Please make your selection now. And it looks like overwhelmingly people selected balance sheet.
Okay, good job. Yeah, balance sheet again is the one thing that's going to be going to have the impact. Okay, I'm not going to go too much detail, but if you have modifications, all right, the first thing you have to assess is this a separate contract or is this just a modification of my existing lease? Okay, it's separate if both of the following exist. If you get an additional right of use and the lease payments are also commensurate with the standalone price for that additional right of use. Okay, you meet both those criteria, it's a separate contract and you have to count for that as a separate lease. All right. If it's not a separate contract, you need to account for the modification at the effective date of that modification, and you would use the discount rate at that particular point, and then you would just remeasure that lease liability at that point. All right, so you wouldn't go back in time and try to fix things. You would remeasure the lease modification at that point in time. All right, sale leaseback transactions. Under our current GAAP rules, and this is something that kind of falls under Rev Rec, but our current GAAP rules, it allows for a gain. If you have a sale leaseback, the gain, typically you have a gain on a sale leaseback. It gets recognized over the term of the lease. The new rules would would fall under the rev rec, but you'd actually recognize the full gain if it qualifies as a sale under the new rev rec rules at the sale date. Okay, all your sale leaseback transactions would end up being operating leases. So related party leases. This is a question I get lots of times. Say, hey, listen, I'm a privately held company. We've got a lot of related party leases. And what the rules say is that you account for those leases based upon the legally enforceable terms of that lease. Even if the terms are different from the substance, saying, hey, really the substance of it is this, whatever the legally enforceable terms are. Now, frankly, I've got some clients that have a lot of related party leases. They can make it, the leases say what they want. So we don't evaluate the economic substance of the arrangement. You use what the actual legal enforceable terms are. All right, and hopefully some people have some of these questions I see kind of flipping up. But presentation, okay, so your finance leases, and again, not much of a change, but where our balance sheet, we have a right of use asset and liability. You can either separate those as separate line items on the balance sheet, or you can disclose separately in the notes of the financial statements. Okay, so not very different than what we have now. You can put this in a footnote as a separate line item within your PP&E footnote. We have the same considerations of current versus non-current. Some people may choose that they want to make this a separate line item on the balance sheet. I think most people, some of the examples that I've seen, most people just bury them in their footnote and disclose them with all their other fixed assets. All right, so operating leases. Now, this is where it's a little bit different. You need to either separate that as a line item. You can't lump these in with your finance type leases or what we used to call capital leases. They have to be a separate line item. You can also put these in a footnote. It just needs to be disclosed separately, okay? So you can't bury it in some other line item, all right? So, and also you still have the same current versus long-term considerations that you have with any other liability. All right. All right, so we have a lot of disclosures. I'm going to go through all of these. Just to tell you, though, these disclosures feel and look a lot like debt, okay, because they're basically saying that these are debt obligations. So you're going to have, things like still have your maturity analysis. You have weighting average lease term. If you have judgments, you need to disclose that. This is a disclosure. I don't know that I would do it this way, but this is just an example. Some of the things you'd need to disclose. If you wanted to break out your total lease cost into all these different components, you have the finance lease costs, which is obviously your amortization of those right of use finance type leases. Keep in mind, you're also going to have some interest on those liabilities. You've got an operating lease cost. You may have some short-term lease costs that don't meet the criteria, that are less than 12 months, okay? You could have some variable lease costs. You could have sublease income. So those are all just pieces if you wanted to do it that way. Like I said, I probably would disclose it a little bit differently, but those are just some components there. All right, so transition approaches. Now, they're going to make it easy on you. If you have existing contract, when this lease standard goes into effect, they're not going to expect you to go back and reevaluate whether something was a finance type lease or an operating lease and change the accounting. So if it's an expiring contract when these rules come into effect, you don't have to go back and change that. You also have to assess whether it was a lease or not. Okay, so you get a pass on that. You don't have to assess your indirect costs. And also, this to me falls under common sense, but they're going to allow us to use hindsight in determining reasonably certain. Okay, so they're not going to expect you to go back and say, when I entered into this lease, I would have been reasonably certain to do this or that. You can obviously use, the knowledge you have today of all what's happened for the lease to go with how you're going to book this today. All right. So that's the transition. It's kind of a more higher level. And really, when you look at the summary of the impacts, if you need some things to take back to your boss, what did you learn today? All leases going to be most all leases going to be on the balance sheet except for your short-term items. Classification still matters. We talked about judgments. There's going to be new judgments to identify a lease. All right, and that's where I think it's going to be the hard part is, there's probably people that have operational people entering into leases, how is that information going to make it back to the accountants, the people like you guys on this call that have to implement this stuff? It's going to be difficult to kind of stay on top of this. If there's anybody working at publicly traded companies, I mean, you're going to have to build some financial internal controls around this. How are we going to have the controls in place to make sure we get the right answer on classification? Is it a lease, modifications? So you're going to probably have to establish some new processes or policies, just to make sure you can comply with our SOX requirements. Obviously, we have more disclosure requirements, and as I just mentioned, your process controls and financial reporting to track information. So that's it, guys. I have 12 o'clock. I should have 12:01. So I got to make sure we stay on time. I've got some questions here that I want to try to get to. Shannon, I guess I assume people can hang on if they want to hear the questions out. But
yeah, they
I think everybody can
hang on.
Okay. Well, let me read a few of the questions for whatever time will allow. Somebody asked, will the standard allow for me to lump similar leases together? The answer is yes. The standard has what they call a portfolio approach, which allows you to group similar leased assets into a portfolio, for determining classification and measurement. They just want to make sure it's not materially different if you had to apply those to individual contracts. All right? So it's probably, if you have a lot of similar homogeneous type assets, you could kind of apply the portfolio approach. Okay? Let's see, we have another one here. Is there a de minimis or materiality threshold? Unfortunately, there's not. And the international rules, I think, have some sort of de minimis, I think like $5,000 or something like that. But there isn't one for U.S. GAAP. But I'll be honest with you, every single accounting standard, and I'm, this is coming from an auditor, materiality should be your best friend. If something is small, you should be able to talk to your auditor or CFO to say, look, if something's that small, it's not material to our financial statements, you maybe don't need to comply. But you'd have to figure out the materiality of that. Okay, someone has another question. How much more time we have? Someone has one that says, hey, is it possible for me to structure a lease, all my leases for 11 months with no renewal to avoid all this mess? Well, the answer, I think the right answer is yes. If, again, as I said on that one slide, if it's legally enforceable and you don't have a purchase option, there's no automatic or renewal or something like that, I suppose you could, but you got to think about it. You got to have some sort of lessor that's willing to work with you on that. So, I have rental properties. I don't know that I'd allow my lessees to go. I wouldn't go along with them to sign a bunch of 11-month leases just to comply with some, or just to get around some accounting rules. So I think you need to have a willing lessor that would really be willing to do that. But I suppose that is possible. Okay, some people have done that. All right.
Good. Well, thank you, Billy, and everyone for attending. If any additional questions that were asked that weren't answered, Billy will follow up with you personally. I want to thank everyone for attending today. A follow-up email with an evaluation form must be submitted in order to receive your CPE certificate for the CPE course, so please check your inbox for that. Thanks again for attending, and everyone have a great day.